What if I told you that there is a method of trading by which you can know whether whales are buying and selling and you can trade along with them? I'm sure you already know about the institutional players or the whales as I call them run the forex market. But did you know that the whales might make up for only 20% of the total market participant, but they are responsible for generating 80% of the total liquidity and volume in the forex market, and that is huge. Now tell me, wouldn't it be cool if you could know when and where these whales are entering the market, where they are buying and where they are selling? So in this video, I will show you just that. Hi, I am Daksh from ForexMonopoly, and in this video I am going to tell you about this thing called as order blocks and order flow, which will help you understand when the institutional players get in and out of the market. And also do not skip on this video and watch it till the end, as the concept I am going to tell you in this video will help you get ahead of 80% of the dumb traders that fail. Now, why do I call them dumb traders? Watch the video till the end to know about it. So before I get started with order blocks and order flow, you need to first understand the concept of big money and small money. So let me just quickly tell you what big money and small money mean. So as the name suggests, big money refers to the institutional traders that trade with a huge capital. And with huge capital, I mean millions and billions of dollars. While the small money includes traders like you and me that trade with a smaller capital comparatively. Now, when we trade or when any other retail trader trades, our trade sizes are not going to be very big, as our capital is just a fraction of that of the big money. So this in turn will get our orders filled very quickly, as the liquidity in the forex market will be able to easily accommodate the orders that we place. But when the big money trades with their millions or billions of dollars, they do not have the luxury of their orders or their trades getting filled with ease. Since they trade with such a huge capital, their trade size will also be huge, isn't it? So these traders have to see if there is enough liquidity in the market for their orders to get filled, and they also have to ensure that their orders do not disrupt the price due to its huge volume. So what they do is they buy and sell at different places, maintaining a good average price, which sometimes is also called as dollar cost averaging. Now let us try to understand what I meant more clearly, and also let us see things from an institutional trader's perspective. Now suppose you are an institutional trader and you had a cool $100 million to trade, and you have to buy USD CAD currency pair at a price range, let's say from 1.2700 to 1.2600. So this is just for an example. So what will you do over here? Will you place one single order with 100 million? No, you won't, and I will tell you why. If you placed one single order to buy, it is highly possible that there won't be enough liquidity for your order, so you won't be able to enter the long position in the currency pair. And if you do, your order will be filled at different prices nearby your mentioned level, and the price will see a wild spike as orders are getting filled quickly at different levels and in large quantities, which will give you a higher average price. So what you will rather be doing is that you will break this into chunks and will start placing orders from time to time and build your portfolio all the way up. Here the institutional trader will place, let's say, 10 orders worth $10 million each, and once each order gets filled, they will then have a complete portfolio of the USD CAD currency pair worth of a total 100 million. And a tight range type structure will be formed on the price chart, which will have prices moving between an upper level and a lower level, and this is called as an order block. You can call it a tight price range or even consolidation and even accumulation. These are just different words for the same thing, which is order block. So now that you know what order block is, let us understand what is order flow. So whenever an order block gets filled in the market, what happens is that the liquidity in the market is being absorbed quickly and in large numbers. And as this happens, prices is bound to go or move in the either direction. So at any time in the market, if the buyers are more than the sellers, then the price moves up, and if the sellers are more than the buyers, then the price moves down. Now we have already spotted an order block, and in this the price is in a tight range. So at some point in time, the price will move out of the tight range because it cannot stay within the range forever. So whenever the range is broken, the price will start to move in the direction where it broke the range or the order block, and this is called the order flow. Now let's say the price breaks out of the range and has already started moving in a direction. So retail traders straight away jump into the trades without any plan, and they hope to ride along with big money. So is this something you should do it too? This is exactly the reason why retail traders are at times called as dumb money, as they blindly enter into trades just out of fear of missing out and with no plan whatsoever. So should you also be doing the same thing? Not at all. This is just a herd following, and you should avoid it if you want to protect your capital from losses. The main difference between a dumb trader and a smart trader is exactly this, that the smart trader do not act impulsively and blindly. Instead, they have a plan that tells them when exactly they should buy and sell, and they strictly act according to this plan at all the times. And this is where order blocks trading is going to help you elevate your trading performance and results. If you have been following everything I have said until now, you must have understood that order blocks are somewhat footprints left behind by the big money on the price charts, and order flow is retail traders jumping in and absorbing the liquidity. Now, in order to trade along with the big money or the whales, you first need to learn how to spot order blocks on the price chart, and in the next video, I'm going to teach you just this. I will be sharing a pro tip that you can use to spot order blocks efficiently, and also the next video after that which I upload will consist a strategy which uses order blocks.